Welcome to our beginner's guide to financial ratios. If you've ever wondered how investors and business owners quickly assess a company's health, financial ratios are the answer. These simple calculations help you make sense of financial statements, compare companies, and spot trends. Today we'll break down the most important ratios, explain what they mean, and show you how to use them. Whether you're a student, aspiring investor, or just curious about finance, this video will give you a solid foundation. Let's start by understanding what financial ratios are and why they matter in the world of business and investing. Financial ratios are simple calculations that use numbers from a company's financial statements. They help you analyze a business's performance, efficiency, and stability. By comparing different ratios, you can quickly see how well a company is doing compared to its competitors or its own past performance. Ratios are used by investors, managers, and analysts to make informed decisions. They're like a financial health checkup for any business. In the next scenes, we'll explore different types of ratios and what they reveal about a company's operations. There are several categories of financial ratios, each serving a unique purpose. The main types include liquidity ratios, profitability ratios, leverage ratios, efficiency ratios, and market value ratios. Each category focuses on a different aspect of a company's financial health. For example, liquidity ratios tell you if a company can pay its bills, while profitability ratios show how well it's making money. Understanding these categories helps you know which ratios to use for different questions about a business. Liquidity ratios measure a company's ability to meet its short-term obligations. They show whether a business has enough cash or assets that can be quickly turned into cash to pay its bills. The most common liquidity ratios are the current ratio and the quick ratio. These ratios are especially important for creditors and suppliers who want to know if they'll get paid on time. Let's look at each liquidity ratio in more detail. Current ratio is one of the simplest liquidity ratios. It's calculated by dividing current assets by current liabilities. A ratio above 1 means the company has more assets than liabilities do within a year, which is generally a good sign. However, a very high ratio might mean the company isn't using its assets efficiently. The current ratio helps you quickly assess if a business can cover its short-term debts. Quick ratio, also called the acid test ratio, is a stricter measure of liquidity. It excludes inventory from current assets, focusing only on the most liquid assets like cash and receivables. This ratio tells you if a company can pay its short-term debts without selling inventory. A quick ratio above 1 is usually considered safe. It's especially useful for businesses where inventory might not be easily sold. Profitability ratios show how well a company turns sales into profits. These ratios are important for investors and managers who want to know if the business is making money efficiently. Common profitability ratios include gross profit margin, net profit margin, and return on assets. Each one gives a different perspective on how much profit is being generated from sales, assets, or equity. Gross profit margin is calculated by dividing gross profit by sales revenue. It shows what percentage of sales is left after covering the cost of goods sold. A higher gross margin means the company is keeping more money from each sale, which is usually a good sign. This ratio helps you compare companies in the same industry and spot trends in profitability over time. Net profit margin goes a step further by showing the percentage of sales left after all expenses, including taxes and interest, are paid. It's calculated by dividing net profit by sales revenue. This ratio gives you a clear picture of overall profitability. A higher net margin means the company is more efficient at turning sales into actual profit. Return on assets, or ROA, measures how efficiently a company uses its assets to generate profit. It's calculated by dividing net income by total assets. A higher ROA means the company is making good use of its resources. This ratio is useful for comparing companies in asset-heavy industries like manufacturing or utilities. Return on equity, or ROE, shows how well a company uses shareholders' equity to generate profit. It's calculated by dividing net income by shareholders' equity. A higher ROE indicates that the company is generating more profit from each dollar invested by owners. This ratio is especially important for investors who want to see strong returns on their investment. Leverage ratios measure how much a company relies on debt to finance its operations. These ratios help you understand the level of financial risk a business is taking. Common leverage ratios include the debt-to-equity ratio and the interest coverage ratio. High leverage can mean higher risk, but it can also boost returns if managed well. Debt-to-equity ratio compares a company's total debt to its shareholders' equity. It's calculated by dividing total liabilities by equity. A higher ratio means the company is using more debt relative to equity, which can increase risk. However, some industries naturally have higher debt levels. This ratio helps you judge if a company's debt load is reasonable. Interest coverage ratio tells you how easily a company can pay its interest expenses on outstanding debt. It's calculated by dividing earnings before interest and taxes, EBIT, by interest expense. A higher ratio means the company is more comfortable covering its interest payments, which is a sign of financial stability. Efficiency ratios measure how well a company uses its assets and manages its operations. These ratios help you see if a business is making the most of its resources. Common efficiency ratios include inventory turnover and receivables turnover. High efficiency means the company is running smoothly and not wasting resources. Inventory turnover ratio shows how many times a company sells and replaces its inventory during a period. It's calculated by dividing cost of goods sold by average inventory. A higher turnover means the company is selling inventory quickly, which is usually a good sign. However, too high a ratio might mean inventory levels are too low. Receivables turnover ratio measures how quickly a company collects cash from its customers. It's calculated by dividing net credit sales by average accounts receivable. A higher ratio means the company is collecting payments faster, which helps with cash flow. This ratio is important for businesses that sell on credit. Market value ratios help investors evaluate a company's stock price relative to its earnings, sales, or book value. Common ratios include price to earnings, PE, price to book, PB, and dividend yield. These ratios are especially useful for comparing companies in the stock market and deciding if a stock is fairly valued. Price to earnings ratio, or PE, compares a company's stock price to its earnings per share. It's calculated by dividing the current share price by earnings per share. A higher PE can mean investors expect growth, but it can also signal overvaluation. This ratio is widely used to compare companies in the same industry. Price-to-book ratio compares a company's stock price to its book value per share. It's calculated by dividing the share price by book value per share. A lower PB can signal undervaluation, while a higher PB might mean the stock is expensive. This ratio is especially useful for asset-heavy companies. Dividend yield shows how much a company pays out in dividends each year relative to its share price. It's calculated by dividing annual dividends per share by the share price. A higher yield can be attractive for income-focused investors, but it's important to check if the dividends are sustainable. Financial ratios are most useful when you compare them over time or against other companies in the same industry. Trends can reveal improvements or problems, while industry comparisons show if a company is leading or lagging. Always consider the context. Different industries have different standards, and one ratio alone doesn't tell the whole story. While financial ratios are powerful tools, they have limitations. Ratios are only as good as the data behind them, and accounting methods can differ between companies. Ratios don't capture qualitative factors like management quality or market trends. Always use ratios as part of a bigger analysis, not in isolation. Common mistake is relying on a single ratio or ignoring industry differences. It's also easy to misinterpret high or low ratios without context. For example, a high current ratio isn't always good if it means assets aren't being used efficiently. Always look at the full picture and use multiple ratios together. You can find the numbers needed for financial ratios in a company's financial statements, mainly the balance sheet, income statement, and cash flow statement. Public companies publish these documents regularly. Many financial websites also provide ratio calculations, but it's helpful to know how to calculate them yourself. Let's walk through a simple example. Imagine a company with $100,000 in current assets and $50,000 in current liabilities. The current ratio would be 2, meaning the company has twice as many assets as liabilities do within a year. Practicing with real numbers helps you understand how ratios work in the real world. After calculating ratios, the next step is interpretation. What does a current ratio of 2 mean? Is a net profit margin of 10% good or bad? The answers depend on the industry, company size, and historical trends. Always compare your results to industry averages and past performance for the most insight. Financial ratios can guide important decisions like investing in a company, lending money, or managing a business. Investors use ratios to pick stocks, lenders use them to assess risk, and managers use them to improve operations. Understanding ratios gives you an edge in making smart financial choices. Let's recap the key ratios we've covered. Liquidity ratios like current and quick ratio, profitability ratios such as gross and net profit margin, leverage ratios including debt to equity, efficiency ratios like inventory turnover, and market value ratios such as PE and PB. Each one offers a unique insight into a company's financial health. Congratulations, you now have a solid understanding of financial ratios and how to use them. Remember, ratios are powerful tools, but always consider the bigger picture and use them alongside other information. Keep practicing with real companies and deepen your analysis as you learn more. Financial ratios are your gateway to smarter investing and business decisions.